Hello and a warm welcome to this week's edition of Econoday Unplugged. It's Tuesday, the 7th of December 2021. Mark Pender's on the US East Coast, and I'm Jeremy Hawkins in London. So just when it seemed that the outlook for central bank policy was getting at least a little clearer, the arrival of the Omicron variant, already in around 50 countries worldwide, has helped to fog the crystal ball again. It's going to take a while before the economic implications of this latest mutation can be properly assessed. So, do monetary authorities bite the inflation bullet and adhere to the previously anticipated path of increasingly less policy accommodation, or do they hold fire and see how the virus effects pan out first? Either way, uncertainty levels have climbed sharply. At the end of last week, the VIX, the Chicago Board Options Exchange's Volatility Index, saw its highest readings since January. So, Mr. Pender, before we ask you about Omicron and what's the latest data been telling us about the state of the US economy?
Well, we had the employment report last week, and that was a mixed report. 210,000 rise in non-farm payrolls was well below expectations. And it was really, for me, it was a negative report. The participation rate did go up a couple of tenths to 61.8, and the Hawks use this as a sign of kind of a new normal of a maximum employment at a lower rate of participation. This rate was over 63% going into the pandemic. So there's fewer people.
Where was it sort of on average before we actually had this pandemic in the first place?
I think it was like 63.2, 63.3%. And that was actually historically subdued. So there's fewer and fewer people, and this is a break lower. We're below 62% now. So there's fewer people in the U.S. Employment labor market. At the same time, we've had a couple of years of population growth, normal population growth. So this is it. The reading here is pretty concerning. But for monetary policy, the available labor market is the available labor market, and we had some indications of wage pressures, 0.3% rise, which is kind of a moderate rise, but that follows higher rises before. The annual rate at 4.8% is is elevated, but really it all goes back to that third quarter employment cost index, which is a separate report released by the Labor Department, which is very closely watched, which is a concentration on employment costs, and that was 1.3% on the quarter, and nothing like that had ever been seen. So that was this is a lasting echo of wage pressures. So, and if this is the new, it's a hollow achievement to have maximum employment at this lower level of participation. But if that's what it is, that's what it is. And if it's going to be inflationary, wage push inflation, then presumably the Fed will have to act. But the big report this week is going to be the CPI on Friday. This was super elevated in the last report at 0. If you remember that last report, that's what kind of kicked the asset, accelerating the tapering. It was 0.9% on the month, which had never been seen, or was last seen during the Iranian Revolution or something like that. And the core was 0.6%, and that excludes energy as well as food, which is also going up. And the Econoday's consensus is not for much moderation. 0.7% monthly headline is an outrageous.
If you analyze that, we're talking, well into
almost a double digit.
Yeah.
It's high single digits on the year, and 0.5% on the month for the core. The annual rates are seen at 6.8% overall and 4.9%. So if these numbers do come out, where does Omicron fit? Maybe it'll be a scientific update. The FOMC will meet Tuesday and Wednesday next week. And maybe there'll be some kind of report between those days, Tuesday and Wednesday, that could actually change the balance of the view, because it is so much up in the air. There's certainly now in the U.S. With Dr. Fauci coming out and saying that It looks to be a mild. Omicron looks to have a mild disease component, whatever, whatever effect. So if it is mild, and you can see the markets are recovering sharply now, the stock market. So if that's what we see this time next week, and it's too early to tell, then I think and especially if we see the CPI come in on expectations, which is super elevated, then I think we will see the Fed announcing next week, both, two different things, recalibrating their wording on inflation, throwing out the word transitory, which Powell disowned last week.
Let me ask you. I wanted to ask you about that, because I'll just quote what Mr. Powell said last week. As you say,
Okay.
with regards to the transitory, I think it's probably a good time to retire that word and try to explain more clearly what we mean. So what do you think he's going to say, and what do they mean?
Well, they their blame. They hardly ever blame themselves for poor communications, but they got themselves into a trap. 6 months ago, isolating the cause of the inflation to bottlenecks, not to massive amounts of fiscal and monetary stimulus, but to what they had saw at the time as physical obstruction, choke points in the global economy that were bound, they thought, to clear up. But it's more structural than that. So, but they really can't blame themselves. That I think that they would, deep in their heart, they may wonder, are we responsible for this in some part? But they're not going to. Powell hasn't given any indication yet of admitting this. So it's going to probably be pinned on problems in the supply chain. They're going to be blaming the global supply chain for the physical limitations of the supply chain. That's the supply side, not the vast amount of demand that's been unleashed by all this monetary and fiscal stimulus over the globe. So I think that's how they're going to play it. They're going to emphasize the supply and choke points and not the demand and policy points. But at the same time, they'll be revealing themselves because they're going to be tapering. They very well may double their the pace of their taper. So right now they're been reducing their Treasury and mortgage-backed securities purchases by $15 billion per month. That could go up to $30 billion. So $20 billion less for Treasuries and $10 billion less per month for mortgage-backed securities. So that's a lot less printing money to buy bonds. So that can't be very good for the bond market. So, but in any case, unless Omicron really does come out and surprise everybody with being serious cases that begin to unfold, because when you read the reports, they are rising, including in Europe, and I'll let you go there. But you don't see hospitalizations increasing yet. But maybe it takes a week or two. So if that does happen, then everything is out the window for the Fed. Yeah. But if Omicron behaves itself, then I do definitely think you'll see a rejiggering of inflation, somehow trying to deflect blame from monetary policy, and then a faster pace of tapering.
Okay, fair enough. That all makes sense. And I guess one thing it's worth saying about Omicron, of course, is that what would the net impact of Omicron, if it is, let's say, reasonably serious, be on inflation in the first place? And the temptation is to suggest that, well, it's going to hit economic activity, and therefore that's going to start putting downward pressure on prices, particularly commodity prices. However, just from from the Delta experience, there was actually much more of a hit to supply than there was to demand. As demand started to recover, of course, that's one of the reasons this gap we have between demand growth and supply growth, that inflation is where it is at the moment.
Okay, well, let me ask you now. We have a lockdown in Germany, is that right? And how is this going to affect things?
Well, we don't actually have a full lockdown yet, but what Germany and indeed most of Europe, or continental Europe anyway, since our last podcast, they have been tightening measures, notably with regards to overseas travel. But as far as Germany is concerned, as of December the 2nd last week, they decided there'd be tightening restrictions for those unvaccinated against the COVID virus, which means unless essentially you got what's called
But that's a third of their population, right?
well, it's getting on for that.
So that's a lockdown.
Well, it's a partial lockdown, certainly. And it does mean that those people will no longer have access to non-essential shops, restaurants, culture and leisure places and that sort of thing. And indeed, they are at the moment, they've got a draft law on mandatory vaccination, which is expected to be submitted to Parliament, I think, for entry into force around about February or March of
mandatory.
Next year.
So mandatory vaccinations for?
But it sounds like pretty well for everyone, unless for whatever health reasons you won't be, you don't actually have to have it. That has to get through the German Parliament, so that's not guaranteed it'll happen yet. But it is nonetheless, I think, a fairly clear indication of what's happening in Europe. You mentioned Austria is in lockdown, we know, and indeed that's been extended now until at least December the 11th. France has introduced tighter regulation. I mean, it really doesn't matter where you look at the moment. It's pretty much the same thing.
And we haven't seen anything in the data on social unrest affecting the economic numbers yet. We had the Belgian, over here, we see riots in the streets. It was Austria a couple weeks back or a week back, and now we saw it in Belgium. Are these isolated? Are these small? Are we going to start seeing these somehow? We have seen vaccination refusals appear in U.S. data in small numbers and Challenger layoff data. 20,000 layoffs a month in healthcare, essentially people refusing to get vaccinated. So we are seeing little glimpses of this. Where would we see, is social unrest being overplayed by the press?
I think, yes, I'm thinking social unrest always makes for a good story, good front page stuff. I think what we've seen in Europe, and so far anyway, to a much lesser extent in the likes of the UK, there are certainly pockets of genuine unrest. And that's why governments, by and large, have been extremely reluctant to actually go, the full hog, so to speak, and introduce lockdowns. Now, obviously, Austria has done that. They're effectively going down almost the zero COVID route, like we've seen in parts of the world like China and so on. But for most of the others, it's been a gradual tightening of restrictions, which obviously hasn't gone down well in some quarters. But from what we've seen so far, I think it's more a case of pockets of resistance, which at least to date haven't really had any obvious impact upon the economic data themselves. Now, clearly, if they start spreading and become more intense, then it could well be the case that the numbers do start being impacted. But at the moment, I think it's probably fair to say that, looking at the numbers, they seem to be following the kind of pattern you'd expect for this, this stage of the economic cycle. But just quickly sticking with COVID, I think it's important to note that I think from your side, and certainly looking at the way the US market's performing, there has been some pullback and some sense of relief, but perhaps Omicron won't be as bad as originally people thought it might be. In Europe, the issue is, of course, that COVID has already had a huge impact over the course of the last couple of months. So countries like Germany, Belgium are at record levels of COVID infections. And indeed, it's true for the European Union as a whole. And as a result of which, some countries are actually running out of ICU bed spaces now. They're actually having to all intents and purposes, export patients across borders. So here there is much more of a concern that even if, and let's all hope so, that Omicron is not as dangerous a threat as might have been the case, if we're going to see hospitalizations continue to rise, there's simply a shortage of space. There's a lack of hospital beds.
I saw something on BBC in Wales, and some hospital put out some bulletin that don't come here.
It is, yeah, it is getting exactly like that. It's a real
so
issue.
what does that mean for the Bank of England next week?
Well, it's a good question. I must probably talk more about that next week, because at the moment it really is up in the air. But I think it's fair to say, listening to the comments coming out from the Bank of England prior to the back end of last week when the Omicron first broke, I think most forecasters, analysts are going down the view that, okay, they didn't tighten last November. No one's completely sure still why, but they're going to tighten this month. However, since the new variant broke, there's crucially, I suppose, at least one set of comments coming out from Michael Saunders, who's typically regarded as perhaps the biggest hawk on the Monetary Policy Committee. And he was quoted, was it yesterday or the day before, essentially saying that, well, this Omicron variant could be a hit to the economy. We don't know what the effects are going to be yet. Therefore, it may make sense to just give it a little bit longer and see what happens. Now, something which makes sense, I think, going down that route is that traditionally, like so many central banks, the Bank of England likes to operate on the basis of what its latest economic forecasts are saying, and they're contained in its monetary policy report. Now, it had one of those last time, but it won't be getting one now until February of next year. So that then would give it a couple of months or so to have a look at what this virus is doing before actually pulling the plug. To come out and pull the plug now when there's greater uncertainty about the economy than there was back last month when they had the new set of economic forecast. We didn't know about the Omicron variant. It kind of sort of, I think, tugs at the edges of their own credibility. Now that said, there's some other members, Mr. Broadbent, Ben Broadbent, who's one of the deputy governors, who's typically regarded as being fairly neutral and so perhaps a better guide to how the majority vote will go. He made some fairly sort of slightly hawkish comments by his standards yesterday, really just pointing out the obvious fact that inflation is too high. He's now talking about it going well above 5% next year. And the current bank forecast is for a peak of about 5% in the first half of next year. Well, he's now suggesting it's going to go well above that, and emphasising the fact that there's this risk of the second round impact on wages, which makes next week's labour market report all the more important to watch.
So then for people now, the BOE meeting is on Thursday next week. You're going to have the labour market report, which will have the wages data. That's going to be on Tuesday. And you're also having a CPI report
on Wednesday. So two of the most important numbers, and it's literally the case currently, I think, that most MPC members, I suspect at the moment, don't know how they're going to vote next week. When they didn't decide to tighten in November, they made it very obvious they wanted to see the numbers between now and the December meeting to help to clarify the situation. So I think next week's numbers, notably the labour market report and the wages component of that, could be instrumental in tipping the balance one way or the other as to whether or not rates do go up or they're just going to hold fire for the time being.
Wow, so that's a hard one to call. Now, okay, so now the ECB also meets on. Do they have a 2-day meeting? The ECB, is it a 1-day meeting with the announcement on Thursday?
It's essentially sort of a 2-day meeting, but nothing is ever said until we actually get to the announcement on Thursday.
Now, the ECB, they've been downplaying inflation, or not downplaying it, but they haven't been reacting. Is that a fair thing to say about the ECB?
It is and it isn't, which I suppose is a classic economist answer. Yes, in general, it's exactly right. They have been very much one of those banks who have been towing the line that don't worry about it. We know inflation's going up. It's going up for one-off reasons, the usual stuff, COVID, oil prices, supply chain disruptions, etc., and of course the German VAT effects. So don't worry, because it's coming down next year, and indeed in January, unless something wacky happens to oil prices, it'll almost certain headline rate will almost certainly come down, and indeed the core rate, just because of the fallout of the VAT effects coming out of Germany. But because prices are so high now and been rising so quickly, there's a number of hawks on the ECB who really are starting to get increasingly rattled now, notably the German contingent and the Dutch contingent as well, who really are clearly very unhappy with what's happening in inflation domestically because it's well above the sort of rates they want to see. And they'd like to see, well, ultimately a much less accommodative monetary policy. And they're going to be pushing hard at next week's meeting for the ECB to come out and, well, as far as they're concerned, they'd probably like to see the PEP, the Pandemic Emergency Purchase Programme, being ended in March, which almost certainly will be, unless Omicron turns out to be really nasty, and not replaced. That then would take out a big chunk of the current quantitative easing programme. It still leave the old asset purchase programme, which is running at 20 billion euros a month, but it would wipe out the best part of 60 billion a month or so of euros, which the ECB is currently purchasing under the PEP. That's what they'll be after. I don't think they'll get away with that, but there's a good chance I think the PEP will end, and if they introduce a replacement, it'll be of a much smaller size. But to answer your question, there's splits within the council gaps of which have got wider and wider as inflation has gone up. And I think the big concern for some is that, okay, inflation peak will be transitory in the sense that special factors will automatically pull inflation down next year. But if you look at the gap, for example, currently between the producer price rate of inflation, so pipeline inflation, and HICP, or
that's
consumer
20%. We're at the 20%.
Well, the gap between the two is currently running at 17.8 percentage points. The gap between the two core rates is at 7 percentage points. Now, these are pretty, unprecedentedly big gaps. And it really, to the extent that the PPI isn't a bad leading indicator, it's not perfect, it's not a bad leading indicator of CPI inflation, it really does suggest that underlying CPI inflation is going to have to rise further. And that's what the hawks on the ECB are getting increasingly concerned about.
Well, that gets right to the transitory issue now. If the Fed, and let's talk about, okay, so, transitory being in the producers and the supply side, but let's also talk about global economic central bank policy. There is a conformity in the language. They all went to the same school, all studied under the same professors, all read the same textbooks. But if the Fed throws out the word transitory, what will the other central banks, what are they going to do with their word transitory?
I think they may start watering it down a bit. You may say transitory being shifted in such a way that it gives the impression that inflation's still going to come down, but the lags and the peaks involved are perhaps not quite as clear as they thought they were. Indeed, even ECB President Lagarde, who last week was yet again banging the drum, trying to reassure investors that yes, inflation in the Eurozone will be only transitory. She was admitting, well, it may last higher and somewhat longer than we thought, but don't panic because it will still be low on target.
So it's possible they're all together throw out that word at the same time.
It's possible. I think to be fair to the ECB, inflation in the Eurozone is currently running at 4.9%. So it's a bit below where you are. And of course, the core rate is relatively low at 2.6.
Right. And France was low. I saw your report last week. It was surprising. Was it last week?
Yes, it was.
Sorry. I'm sorry. No, but it's just not all the countries have a high rate of inflation.
No, a number of them don't. That's right. When you're talking about the French rate, where are we currently running up about about 1% or so, something like that, I think. In Italy, the core rate is running well below the 2% mark. So, the hawkish members tend to be countries obviously like Germany, where both the headline rate and indeed the core rates are running well above where they'd want to see them. So in Germany, the core rate is now, the latest figure is probably going to be somewhere around about 3.3, something like that. We've only got the provisional flash numbers at the moment. But for German standards, the 3% core rate is wholly unacceptable.
So what do you see for the ECB next week?
ECB, well, it's not going to be nothing at all about what's happening now because they won't do anything with quantitative easing for now, and they certainly won't do it with interest rates. The focus will be on, I suspect, what they're going to say about the Pandemic Emergency Purchase Programme, this PEP. So they're expected, at least I think the general expectation is that they will announce that as previously suggested, it will be terminated in March next year. And if that is the case, the key question mark is what are they going to do? Do they simply end it? Let's say that's going to put a big hole in their quantitative easing program, or will they replace it with something which I think is much more likely? And if that's the case, what is it going to be? They've already come out. One of the problems for some of these countries, of course, like Greece, is that Greek bonds are still not of investment grade, but they were allowed to be purchased due to special circumstances because of the nature of the PEP. They don't qualify for purchasing under the asset purchase program for long-standing QE part. So if they get rid of the PEP, what are they going to do about Greek bonds? They've already come out and intimated, well, don't worry, we're still going to purchase Greek bonds. But to do that, they'll either have to modify some of the arrangements surrounding the asset purchase program, or they're going to have to come out with some kind of new purchase vehicle, which I guess is probably more likely. So next week for the ECB, it's not kind of what's happening now. It's going to be about what they plan to do as far as next year is concerned.
Okay, now let's talk. Now you also have the Swiss National Bank, and they have a low or comparatively low inflation, very low inflation rate. It is moving a little bit higher, but not very much. What do you see? And they must be sitting pretty right now. With the talk about rate hikes everywhere and tapering, that must help them. And how's the Swiss franc been doing?
Well, it should be. I mean, you're right. I mean, you would think they all talk about, the Fed tapering, and ultimately, that just means that the first hike in interest rates isn't going to be too far away. We have seen some other central banks like Reserve Bank of New Zealand, South Korea tightening as well, which of course should be a negative for the Swiss franc because their rates are so low. I'm just remind folks, their benchmark rate is still minus 0.75%. So that's the lowest amongst all of the major central banks. However, with the arrival of, particularly in Europe, rising COVID numbers before the Omicron variant came out, and since that's happened, there's been a ton of capital flows going into the Swiss franc, and that's meant that the Swiss franc has strengthened through a number of levels.
Flight to safety tied
exactly
to
that.
Omicron.
Yep, very much so. I mean, the Swiss franc has yet again demonstrated it's by far and away the number one safe haven currency for Europe anyway. So we've seen a number of euro Swiss franc levels being taken out by the market, which in the past the Swiss National Bank, I should say, the SNB, has successfully defended. To the extent now, as we currently speak, I mean, euro Swiss franc is trading just over 1.04. Now, that is, bear in mind, this is Swiss francs per euro. So that is well below the 1.07 level, which most investors believe to be the lower limit as far as the Swiss National Bank would allow the cross rate to move. So it's already well below that, 2% or so below that. And indeed, we're at the kind of levels now which we haven't seen for over a year. And the last time we did see anything around these levels, the Swiss bank was intervening massively in the foreign exchange markets. Now, the SNB has been intervening, so it's been selling Swiss francs to try and weaken its own currency and buying euros and dollars. But it hasn't stopped the appreciation of the currency. It might have put a temporary halt to it, but it certainly hasn't helped to reverse it. So it still seems that it's almost got to a stage now whereby markets are even contemplating the idea of, well, are they going to have to come out and cut interest rates again? They certainly don't want to do that. But unless they're going to step up intervention and potentially step it up aggressively, if this Omicron variant starts spreading and becomes really bad news, we're going to see more inflows going into the Swiss franc again. So they are actually in a difficult position. And you mentioned Swiss inflation is low. Well, yes, I mean, however you look at it, it is still very low. Currently, where are we running at just over about 1.5% now on the headline rate. The core rate in Switzerland, so stripping out the usual food and energy, it's just 0.7%. And each time this Swiss franc appreciates.
That's on the year. We went up that in a month. Wow.
Yeah, that's right. And each time the Swiss franc appreciates, of course, it's just reducing still further all import costs. So all prices may be going up in dollars, but the Swiss franc, I think, is one of about the only two currencies that appreciated against the dollar last week, which again, further indication of its general appeal as a safe haven currency. But imported inflation in Switzerland, well, it's still negative. It's still falling, and that's keeping a lid on Swiss inflation, which the SNB would actually like to see go up the time when all these other central banks are worried about inflation being too high.
And what day is their meeting next week?
Will they intervene next? They're intervening probably at the moment. They've been intervening now for, we reckon, the last 3 or 4 weeks.
No, but their policy meeting.
Oh, their policy meeting, I think the key thing to watch there, I don't think they will cut interest rates yet, but it's got to be said it's at least an outside possibility, because for most of the MPC, they hate having interest rates in negative figures. But what they probably will do, I suspect, is change some of the language about the Swiss franc. They've been saying it's highly valued. At one point years ago, they used to say it as overvalued, and I think they may well come out with that. And perhaps then what they're going to look for, I suspect, is to catch the market, long Swiss francs against the euro, and then intervene really aggressively and try and get a big knee-jerk reaction coming out of the market.
Okay, everybody. So Thursday, December 16th, it starts off with the Swiss National Bank first. And then a couple hours later, we're going to get the Bank of England.
Bank of England, yeah.
And then folled by the ECB.
Super Thursday, as they're calling it. Yep.
So that's going to be a hectic day.
It is. Okay, just quickly to round up then before we talk for too long, should mention Bank of Canada, their meeting is tomorrow. That really ought to be a bit of a damp squid. I mean, they've already pulled the plug on quantitative easing, so they're just looking now to stabilise their balance sheet. I suppose the key thing to watch there, currently they're kind of hinting that the first hike in official interest rates there could come about in April. The numbers out there, by and large, of late have been very good. The employment report was particularly strong. Inflation we talked about previously is well above where it should be. So Mark was talking about perhaps pulling forward, Fed tapering, and ultimately when Fed rates may go up, it may be a similar sort of a story coming out of Canada as well. The Reserve Bank of Australia, which met yesterday, they announced no change in policy as expected. I guess the main thing to say there was with regards to Omicron. Their view at the moment is it's a new uncertainty, but it shouldn't derail the recovery. I guess, same as any other central bank at the moment, just having to wait and see what the final effect is going to be. No change expected out of India this week. And the People's Bank of China yesterday, they announced a cut in bank's reserve requirements of 50 basis points. That comes into effect on the 15th of December. And although it's not an out-and-out interest rate cut, it's a further illustration of the fact that economic growth in China is slowing. So despite all the talk about interest rates going up in so many parts of the world, as far as China is concerned at the moment, particularly given some of the policies, tight regulations, so on, policies they're currently delivering, it's more a case there of the central bank having to keep monetary policy extremely accommodative just to keep the economy growing. Okay, is that it? We done?
I wanted to talk about oil. Oil fell very sharply with the Omicron. And also, the release of coordinated strategic reserves. That's marked. I don't know. We went from the low 80s for West Texas Intermediate to the mid 60s. And since recovering, we're recovering today. Back, I think it's like I last saw like a 68. But that could be a wild card for the bank announcements next week. If oil. You want to keep an eye on oil. If it for some reason resumes its drop, that'll take the pressure off on the inflation. That'll almost make some of the inflation readings, at least the headline readings, a little for November, a little less meaningful, because since those reports were sampled, we've had a big decline in oil. I just wanted to throw that out.
Fair enough, and a good point too. Yeah, it's a question of see whether or not that can be sustained, because certainly as far as Europe's concerned, of course, there's still this political ongoing issue with flows coming out of Russia. And indeed, European stocks are also extremely low too. So if it's a bad winter, again, I suppose weather comes into effect here. If it's a particularly harsh winter in Europe, then we're going to see oil prices here almost certainly start going up again. But we shall have to wait and see. Okay, right then. I guess then probably is it as far as today's concerned. Christmas maybe just about in a corner, but there's still a lot going on clearly to impact financial markets. So do keep up to date with all the key economic data and events in Econoday's global economic calendar. On behalf of Mark and myself, thanks as always for listening. Podcast, we'll be back again next week, and we hope to see you then. Bye for now. Strategic investing and analysis are a lot easier when you can identify patterns and see how economic events and announcements correlate with specific market movements. The Econoday Investors Journal provides a convenient and easy way to follow important economic events every day, every month throughout the year. View the most important market-moving events for the upcoming year in a glance. The Econoday Investors Journal is your essential desktop resource for economic events and indicators, FOMC meetings and announcements, US banking holidays, equity settlement dates, and more. The Econoday Investors Journal is much more than a financial calendar. It's an indispensable tool to help you anticipate active days in the market. Learn the intricacies and interactions of the market, record daily market activity, and explore helpful insights from experienced market analysts. Take advantage of our informative resource centre, which includes a comprehensive glossary of need-to-know terms, clear, concise information on policy and historical trends, useful graphs, and a guide to the influencing factors and people to watch at the Federal Reserve. Order your 2022 Econoday Investors Journal now at shop.econoday.com.